So, picture this. You've been investing for a few years now. You check your account every couple of months. You see the number creep up a little, and it feels almost exactly like nothing is happening. $8,000, then $11,000, then $14,500. You're contributing every single month, doing everything the way you're supposed to, and yet the number on the screen still just feels like a slightly bigger version of the same disappointing number it's always been. And somewhere in the back of your mind, you start wondering, is there an actual point where this starts to feel different? Not eventually. Not someday. An actual number, a specific line you cross, after which compounding stops being this slow, invisible, faintly depressing thing and starts becoming the most powerful financial force you'll ever experience. My name is Jack, and I spend a genuinely embarrassing amount of time thinking about exactly this question, because I used to assume, like most people do, that compounding was just this vague, gradual thing that got better forever in a smooth line. But it's not smooth. There's an actual threshold, a real, calculable point where the math shifts under your feet, and stick with me, because there's actually a second number hiding inside this one that almost nobody calculates, and I think it might be more useful than the first one. Here's a way to picture what we're actually hunting for. Compounding doesn't build like a ramp. It builds like a staircase, flat for a long, unremarkable stretch, and then it hits a single step that changes the angle of everything after it. Most of what I want to show you today is just precisely where that step is and what it looks like right before you hit it. Let's actually find it, because I think seeing the exact mechanics is far more useful than just hearing compounding is powerful, which everyone already knows and which changes absolutely nothing about how people behave with their money. Here's the foundational idea. Every year, your portfolio grows from two sources: the money you personally put in and the money the market generates on top of what's already there. In the early years, your own contributions are doing almost all of the work. Let's say you're investing $500 a month, $6,000 a year, into a broad index fund averaging 8% annually. In year one, you've put in $6,000, and the market has added maybe $250 on top. Cool, underwhelming, but fine. By year 5, you've contributed $30,000 total. Your account sits around $36,500. The market has now added roughly $6,500 across those 5 years. Better, but you're still clearly the one doing most of the lifting here. Now here's where it gets interesting, and this is the part I actually want you to sit with, because this is the exact mechanism behind the step in our staircase. Every single year, two things are happening simultaneously. Your contribution stays roughly flat, $6,000 a year in this example. But the market's contribution grows because it's now working on a bigger and bigger base. At some point, and I mean this very literally, there is a specific year where the market's annual contribution overtakes your own annual contribution. That crossover is the step. Let's actually calculate it, because the answer is more concrete than people expect. With $500 a month at 8% annual growth, the math works out to somewhere around year 11 to year 12. At that point, your account balance is sitting around $105,000 to $115,000. An 8% return on approximately $110,000 is about $8,800 in a single year, which is now more than the $6,000 you're contributing annually yourself. The machine has just quietly taken over the driver's seat. I want you to actually feel the significance of that, because it's easy to skim past a number like $110,000 and not register what just happened. Before that point, every dollar of growth in your account was mostly you. After that point, the majority of your future growth, forever, comes from money that isn't yours, generated by money that already is. And here's the part that makes this genuinely explosive, not just mildly interesting. Once you cross that threshold, the growth doesn't just continue linearly, it compounds on itself. By year 15, that same investor has around $175,000, and the market is now contributing about $14,000 a year, more than double their own contribution. By year 20, the balance is around $290,000, and the market's annual contribution alone, roughly $23,000, is now nearly 4 times what the investor is personally putting in. By year 25, the balance crosses $460,000, and the market is generating almost $37,000 a year on its own, more than 6 times the investor's personal contribution. That's the step in the staircase. Everything after it moves at a completely different angle than everything before it. Now, here's the second number I promised you, the one almost nobody calculates. The exact location of your own personal step isn't fixed. It depends entirely on your contribution rate and your assumed return. And I can give you the formula right now. Take your annual contribution, divide it by your expected return percentage, and that dollar figure is roughly the balance where the machine takes over from you. For someone contributing $12,000 a year at 8%, that threshold sits right around $150,000. For someone contributing $3,600 a year, it's closer to $45,000. Go do that division for your own numbers. I promise it's a more useful 5 minutes than almost anything else you'll do with your finances this month. Let me actually show you this with a second person, because I think comparing two different starting points makes the formula feel real instead of abstract. Take someone contributing $1,000 a month, $12,000 a year, at that same 8% return. Their threshold, using the formula, sits at $150,000. But because they're contributing twice as much per year, they actually reach that $150,000 balance faster than you'd expect, somewhere around year 9 or 10, not year 11 or 12. Their step in the staircase arrives about 2 years sooner than our first investors, not because the market treated them differently, but because they built the base faster. Here's what's genuinely interesting about this. In dollar terms, their step is bigger, $150,000 instead of $110,000, but in time terms, it's closer, not farther away. This is the part people get backwards. They assume contributing more means waiting longer for the payoff because the target number is bigger. It's actually the opposite. A bigger contribution builds the base fast enough to reach a bigger threshold in less time than a smaller contribution takes to reach a smaller one. If you've ever felt discouraged because your personal number, once you calculate it, seems intimidatingly large, this is the thing to hold on to. A bigger number, reached through bigger contributions, often arrives sooner than a smaller number reached through smaller ones. Here's the thing nobody talks about regarding what happens psychologically before you reach that number. The years leading up to it are genuinely, legitimately boring, mathematically, the least rewarding years the entire strategy will ever produce. And this is exactly why most people quit before they get there. Not because the strategy doesn't work, because most people's patience runs out just before the machine turns on, not after. You are, quite literally, closest to the step at the exact moment it feels most pointless to keep climbing. Okay, I want to pause and be really direct with you for a second, because I think this next part actually matters more than the math we just walked through. If you are in the flat part of the staircase right now, if your balance still feels small and unrewarding, the single biggest risk to your entire financial future isn't a market crash. It's you, quietly deciding this isn't working, and walking away 6 months before the step. I'll come back to crashes in a minute, because they matter too, but that quiet walk away is the more common way people actually lose. So, practically, what do you do with your number once you've calculated it? First, actually write it down somewhere, you'll see it. Second, treat everything below that number as foundation laying, not house building. The house isn't visible yet. That doesn't mean it isn't being built. Third, once you know your number, checking your balance stops being about whether you feel rich yet and starts being about how close you are to the step. That's a completely different, more sustainable way to measure progress. And fourth, recalculate your number whenever your contribution changes. Get a raise and bump your monthly investment? Your threshold moves. Have a lean year and have to cut back temporarily? Your threshold moves the other way. This isn't a number you calculate once and forget. It's a moving target that tracks your own financial life, which is honestly part of what makes it useful. It's not some fixed destiny. It's a live readout of exactly where you stand right now, based on decisions you're actually making. And here's something genuinely underappreciated. Once you cross your personal threshold, the psychological experience of investing changes in a way that's hard to describe until you've felt it. You start noticing your balance, moving on months where you didn't contribute anything extra. A single strong quarter starts adding more than an entire year of contributions used to add. The relationship between your effort and your results, which used to be tightly linked, becomes almost completely decoupled. Now, the crash I mentioned earlier. I want to be honest about the flip side, because this isn't just an uncomplicated good news story. Once your balance is large enough for the market's contribution to dwarf your own, a bad year hurts more too, in absolute terms. A 20% drawdown on $110,000 is about $22,000. That's a real number, and it can feel alarming even to someone who understands, intellectually, that the long-term trajectory hasn't changed. The same crossing that makes gains explosive also makes drawdowns larger in dollar terms, even while remaining the same percentage. This is why staying invested through volatility matters more, not less, once you've crossed the step, because you have more to lose in the short term and dramatically more to gain by staying the course. Let me bring this back to the staircase one final time. Compounding does not build gradually and smoothly like a ramp. It builds flat for a long stretch, and then it hits a step that changes the angle of everything after it. That step has an actual location, calculable from your own numbers, and it is almost certainly closer than the boring years make it feel. The people who build real wealth aren't the ones who found a secret. They're the ones who kept climbing the flat part long enough to reach the step, at a point where most people had already quit, discouraged by a boredom that was, ironically, the exact price of admission to what came next. Go do the division. Take what you contribute every year, divide it by the return you're expecting, and you'll have your number. It's probably closer than you think. And once you cross it, you're not investing anymore in the way you were before. You're just maintaining a machine that's already decided to work on your behalf, whether you're watching it closely or not. If you found this useful, make sure to like this video, drop your own number in the comments once you calculate it, I read every single one, and subscribe to this channel for more breakdowns like this. Thanks for watching, and see you in the next video.